Hi, I'm Brent Stafford, and this is RegWatch by RegulatorWatch.com. Spoofing. It may sound harmless and frivolous, but it's no joke. Something at least one Canadian-based trader can attest to. The Ontario Securities Commission just wrapped the first case ever launched by the regulator to clamp down on the deceptive trading practice. Spoofing has a destructive impact on stock prices and could trigger devastation across the broad equity market.
This market is dropping precipitously. It just went negative 500. It is now negative 560.
Well, suddenly it's down 300 more from when I sat down. You're getting a little more interesting.
In May of 2010, a wave of automated selling wiped $1 trillion off the U.S. stock markets in a flash.
Gone. Everybody's now on the sell side, selling it out.
Plunging nearly 600 points, then rebounding, all in just minutes. The flash crash cost investors hundreds of millions of dollars and proved an embarrassment to stock exchanges and regulators.
It's too bad. The system obviously broke down.
Originally, the cause of the flash crash was pinned to a massive $4 billion sell order issued by a U.S. mutual fund, which metastasized by high-frequency trading. But now, U.S. regulators and the Department of Justice believe spoofing played a central role in the crash, and last April charged Navinder Singh Sarao, a lone trader from the UK, with 22 counts of market fraud and manipulation.
This sole practitioner in England was the 5th biggest volume trader in the E-mini S&P futures contract just 2 days before the flash crash in 2010, basically by putting up fake sales orders to fool the market into thinking there was more selling pressure than there was.
And that's quintessential spoofing. It's an illegal bait-and-switch tactic whereby a trader floods the market with multiple orders of a certain security, which creates the appearance of market interest and artificially drives the price up or down. Others in the market react by either buying or selling, and then the trader cancels the fake orders and profits by taking the other side of the trade. While this very week Mr. Sarao fights extradition to the U.S., facing charges of alleged spoofing, Zhen Stephen Pang, the Canadian-based founder of Oasis World Trading, is now in the second month of a 12-month sanction for market manipulation, and what the Ontario Securities Commission charged was intraday spoofing. Headquartered in Hamilton, Ontario, Oasis conducts proprietary day trading in Canadian equities, but operates from nearly 40 branch offices located in China. From there, approximately 200 Oasis traders conduct the day-to-day trading, overseen by Pang in Canada. According to the settlement reached with Pang and Oasis World Trading, Oasis traders engaged in at least 460 incidents of market manipulation, involving at least 24 different securities over a 13-month period between 2013 and 14. The agreement states certain Oasis traders engaged in intraday spoofing, and the spoofing led to a false or misleading impression as to the supply or demand for shares listed on various Canadian marketplaces, and allowed Oasis traders to trade at artificial prices. Further, these orders were intended to deceive and did deceive certain counterparties. The OSC acknowledges that Pang did not know Oasis traders were engaged in manipulative trading, but as a director and officer of the company, he ought to have known, and he failed to adequately monitor trading activities at Oasis and to ensure there was an adequate compliance structure in place. In the settlement, Pang was prohibited from any involvement with proprietary trading at Oasis for 1 year, and the company was fined $225,000. You can find the settlement agreement posted with this video on RegulatorWatch.com. Joining us today to talk more about spoofing and the Oasis case is Douglas Cumming, Ontario Research Chair in Economics and Professor of Finance and Entrepreneurship at the Schulich School of Business at York University. Douglas, thanks for coming on. First off, do you think the level of enforcement, the punishment, is appropriate in the Oasis case?
It's hard to know without knowing exactly how much money was made by this illegal activity. The general rule of thumb is that you want the punishment to well exceed the benefits that were obtained by doing this type of manipulation. That's what we'd really hope for.
We've talked a lot about the OSC in today's video, but there are other Canadian regulators involved in these types of cases. Is that not correct?
The first step in detecting this type of manipulation comes from IROC, and the enforcement comes through the OSC, and the OSC has done a very good job here.
Douglas, do you think spoofing represents a major threat to the integrity of the market?
I think it is quite serious, although, when you have regulators, if regulators are doing their job, so if the enforcement staff at IROC have their alerts set at the right level, then they will be able to pick that up and nip it in the bud, so to speak, before it becomes a serious problem. It's harder, perhaps, to keep on top of this on a more real-time basis when you have algo traders. Sometimes folks like to connect spoofing more commonly with HFT and algo trading.
So in your opinion, is spoofing, like in the Oasis case, easy to catch?
It is easy to catch. The harder part is proving and having a big news announcement like this. With 460 times, this is really a series of repeat behavior that has no alternative plausible explanation and makes enforcement action and a press release very, very straightforward. So it's just surprising that someone would think that they could do this that many times over such an extended period, 13 months, I believe.
I think you hit the nail right on the head there, Douglas. The OSC acknowledges that Pang did not know about the spoofing going on at Oasis, but it begs the question, how plausible is it to believe that a supervisor would not know that a spoofing scheme was underway?
Well, that's a great question, and I would be fully supportive of the view that he would either have known or ought to have known. It's the responsibility of the management of any trading shop to have its own surveillance within the company to make sure that the traders are compliant with the regulations of the exchange in which they're trading on. Regulations put an obligation on folks like Pang to know what their staff is doing, and there's no excuse to say I didn't know, because it's an objective standard that the manager ought to have known, because it's necessary to have those internal control mechanisms.
Well, that's it for this edition of RegWatch. Before you head off, please like us on Facebook and don't forget to follow us on Twitter. For RegulatorWatch.com, I'm Brent Stafford.